Mary Lamont,
Here.
Fran McGregor,
Here.
Jeffrey Kirst,
Here.
Mark Mathers,
Here.
also present, Robbie Carson, Valerie Phillips, Recording Secretary.
So I forgot to use the mic, just for the sake of being clear. This is a meeting of the other Post-Employment Benefits Trustees Committee meeting, and we convened and called to order the meeting at 3:30. So item 1.03 is public comment. We can accept public comment over the internet as well as in person. And so I would ask Val whether you received any public comment.
I received one public comment from Mr. Jeffrey Church regarding item 2.04.
Okay, very good, and that was distributed to all of the committee members. Okay, very good. Any public comment here in the boardroom? Seeing none, we will move to item 1.04, action to adopt the agenda. To have a motion to adopt the agenda.
Fran McGregor, for the record, I move that we adopt the agenda.
Jeff Kirst, second.
Okay, we have a motion and a second. All those in favor say aye. Aye.
Aye.
All those opposed, nay. Hearing none, the motion passes unanimously. So now we turn to the discussion calendar, and item 2.01 is approval of the minutes of the committee on June 28th, 2021. Do I have any corrections to the minutes for June 28th? Mary, you?
Just my name doesn't have an E at the end.
Okay, thank you, and sorry about that. Any other changes to the minutes? Okay. I think I'm supposed to ask for public comment on every action item, so I will ask whether we've received any public comment on this item before we take a vote.
We did not.
Okay, then, oh, thought you were going to make public comment there, Mary. Scared me there for a second. Okay. I'll take a motion then to approve the minutes.
Fran McGregor, I move that we approve the minutes from the previous meeting.
I second that.
Okay.
Mary Lamont.
Very good. There's a motion and a second. All those in favor, please say aye.
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 Aye. Opposed, nay. Hearing none, the motion passes unanimously. So item 2.02 is approval of the annual request to authorize the transfer or expense of funds from the Opeb Trust Fund pursuant to Nevada Administrative Code 287.792, not to exceed $6,329,237. This is, an important, though somewhat ministerial, action that the Opeb Trust does make annually. And so to explain this a little bit more, we have Robbie Carson, Assistant Controller.
Thank you. Robert Carson for the record. So as Mark alluded to, this is an annual action item that you guys will see. And it's pursuant to Nevada Administrative Code 287.792, and that dictates that because the trust is a separate legal entity, there has to be an approval by you guys in order to make transfers out of it to the district. So annually, we'll go through and we'll get approval from the board to make the request to you guys, and you guys will have the approval authority. NAC 287 lays out a very specific format for it. So there has to be a letter explaining how the transfers will be used and that we won't exceed those. There's a copy of the final budget that was approved by the board and by you guys. And then there's a copy of the minutes of the Board of Trustee meeting where they approved this request to you. So under NAC, what it says is that if all the requirements are met for this, then it'll be approved. If the format for this request is off, then you guys can delay the approval of this request, but as long as it kind of meets what the requirements are, then the approval should go through. So again, this is just a request, and they're requesting $3.6 million for payments to, or up to $3.6 million for payments to the Nevada Post-Employment Benefits Program, $1.64 million for retiree medical subsidies, and then a little over $1 million for retiree life insurance subsidies, and $25,000 for other professional services, which are used to cover the annual audit of the Opeb Trust. This doesn't necessarily mean that all these transfers will happen. This is just authorizing the district to make them if it determines that they're needed for to cover these costs to retiree benefits.
So again, this is the first time you've seen it, so if you have any questions, please, by all means, ask them.
Jeff Kirst, one or two questions. The three entities that receive the funds are the ones that the trust funds. Am I correct in that?
Are you talking about the three
The
different OPEB plans that
3.6
we have?
million comes from one of the three places that this OPEB trust covers. The other is the life insurance, and then the other is the retiree medical subsidies.
So what this would be, it would be a reimbursement to the district's health insurance fund that covers these costs up front, and then if it's determined that the OPEB should reimburse the health insurance fund, then that's what these will be covered for. So these funds will be coming out of the trust and going into the district's health insurance fund.
Thank you.
So I want to talk about, I'm sorry, Mary, do you have a
Mary
question?
Lamont, if it's not needed, does the money go back in? Or is it just taken out if it's needed?
It's only taken out if it's needed. So the money's sitting in the trust, and it's invested in earning investment earnings, and then only if it's determined that it's needed will it be taken out.
So to clarify a little bit, and we'll talk about this more under item 2.04, these are our estimates of the cost for the fiscal year for these purposes. There's a balancing act we go through when we look at the district's health insurance fund and the OPEB trust. And so we see the costs come in, as Robert said. The health insurance fund is absorbing those costs, fronting those costs for the moment. And a little bit of the balancing act is a consideration of how our health insurance fund is doing and whether they really need to be reimbursed those costs. Our intention, and again, we can go through this more in 2.04 as you kind of look at historically how the district has managed the OPEB trust. Our intention is to let the OPEB trust fund build up as much as possible. So we don't want to have to touch the corpus of the OPEB trust. And ideally, like we had this year, we'll see significant investment earnings so that the trust fund's balance or net position will increase over time, so we want our assets to work for us, right? And we don't want to touch the corpus if at all possible. So district management, financial management will look at the health insurance fund's situation throughout the year and gauge, how critically they need that, i.e. to mitigate rate increases or what have you. But if we feel as if the health insurance fund can absorb those costs, we'll let it so that the OPEB trust fund balance will be allowed to increase. So this is kind of pre-authorization for these expenses, but we may not necessarily transfer these monies out of the trust for these expenses if we don't have to. I hope that makes sense. Mm-hmm. We've kind of come to this place over time, and it's because we kind of, again, have this hybrid model that's not fully pay-as-you-go, but not fully pre-funded. So I hope that makes sense, but we can talk about it more if you'd like.
Jeff Kirst, a question. What happens if for instance, we have the viruses going around and that might increase the need for health insurance? Would that be considered for the following year as a draw on the trust fund? if the expenses exceeded the 3.6 million in the one category, the life insurance, and then the other medical, what happens if the needs exceed what is authorized here, if we vote for it?
So there is a process to augment budgets through the year to provide for additional costs. We've never done that. And so that would be quite unexpected for costs to exceed what we've estimated and budgeted here. There is a process that would allow us to do it. What we actually saw in 2020 and 2021 was that those additional COVID-related costs, and you'd think there would be, right, were offset by lower utilization of other services by district employees. So you remember during COVID, discretionary surgeries or other procedures were put on hold by medical providers in the region and across the nation. So we actually saw lower usage of services during that time by active employees, but I think retired employees too. And so that lower usage of services actually led to lower expenses for the health insurance fund that more than offset whatever additional costs, as someone went into the ICU or the hospital or whatever. So we were worried about that situation, Mr. Kirst, but it didn't come about. So we will see how this year plays out. We could modify the budget. That would have to come to you.
There's a mechanism, and it would come to this committee.
Technically, this budget is administered by the Board of Trustees, but I think it would only be appropriate to take that to you for any kind of budget augmentation before it went to the Board of Trustees. But cross our fingers and cross our hearts, we don't have that situation. Yeah. But that's a great question. Yeah. But we did not see that over the last year.
Correct.
Jeff Kirst, I make a motion that we approve the request from the school district to transfer the approximately $6 million in funds from the Opeb trust, should it be needed, to the district for utilization as needs arise.
Mary Lamont, I second that motion.
Okay, I have a motion and a second. I should have asked about any public comment. Have we received any public comment on this item?
No public comment.
Okay, so we have a motion and a second. All those in favor, please say aye.
Aye.
Aye. Opposed, nay. Hearing none, the motion passes unanimously. Thank you. So our next action item is acceptance of the Opeb Trust Fund financial statements. These have been audited by Crow, our external auditor, for fiscal year 19 and fiscal year 20, and we talked last time about how the fact that we've changed external auditors, and that's the reason why you're just now seeing fiscal year 19 and 20 financials But we have them finally. And so to go over them, Mr. Carson will kind of touch on highlights, but certainly, again, if you have questions about specific statements or numbers in the financials, we can go as deep as you want on these financials. Don't look too excited over there. So take it away.
All right. Thanks, Mark. Robert Carson for the record. So like you said, we have 2 years' worth of audited financial statements for the Opeb Trust. We have fiscal year 19 and fiscal year 20. So I'm going to do my best to walk you through kind of the layout of the financials and hit some highlights along the way. And as Mark said, please just interrupt, holler at me, throw something, whatever you need to do to get my attention. And we'll do our best to answer these questions and to keep you awake. So the first section in the FY19 financials, and it starts on page 1, is our independent auditor's report. So this report's required under the auditing guidelines, and it will tell you that we had an unmodified opinion on these financial reports. So the unmodified opinion is the highest level of assurance that the financial statements are free from misstatements or fraud or anything like that. And that's the best you can get, is the unmodified opinion. I'm happy to say we got that in both fiscal year 19 and fiscal year 20 as we were going through there. So that means we're doing everything that we should be doing, and we're presenting the numbers fairly. So the next section of these financial statements is the manager's discussion and analysis, and we shorten it to MD&A just to save time because we love our acronyms. The MD&A is used to highlight anything that management deems important for the public to know, just so they don't have to flip through and try and dig it out. And we go through and just discuss what we think you want to hear. So the important part in here for fiscal year 19 is the total assets and total liabilities and the net position restricted for other post-employment benefits. That bottom line, that net position for fiscal year 19 was just a shade under $60 million. And then in fiscal year 20, it was $65 million. So as you can see, in fiscal year 19, the net position grew slightly, but at fiscal year 20, it grew just over $5 million. So we'll get through the historical trends in there, but it did grow, which is what our goal is, instead of drawing it down to zero. There are other pieces in the MD&A where they talk about additions and deductions, any of the income that we earned, any deductions and payments made out of the trust. Those are all listed in there as highlights. And then just states that almost all of the trust assets are invested. So the assets for the trust are all cash and investments, and right around 99% of it is invested with the retirement benefit investment fund for the state of Nevada. All right. So starting on page 5 for fiscal year 19, you have the basic financial statements. So this would be the balance sheet and the income statement in the private sector. And it's broken out between the 3 different plans that we have here at the district. So we have the Washoe Health Employment, or the Washoe Health Insurance Plan, and then the Washoe Life Insurance Plan, and then we also have the Nevada PEB plan. So it just breaks out, and this is a prorated amount based on actuarial valuations on where these assets are allocated, and just give you an overall net position on those 3 broken out. And fiscal year 20 follows the same thing, so if you want to look at both of those, we can do that. The statement of changes in fiduciary net position on page 6, that's also broken out between the 3 different plans, and they'll show you any contributions made, an allocated portion of the investment earnings to each different plan, and then any payments made out, and those are actual payments that were made out of the trust in that year for those plans. So.
Jeff Kirst, one question. Can the funds be transferred from one of the 3 to the other 3, or are they locked into each category?
That's a great question. We are still kind of exploring how we would do that. We've had conversations in the past about the assets allocated to the 3 different plans because the liabilities are an actuarial determined value. And so, the retiree health plan has more expenses, and the district actually has a real liability attributed to that plan. So we've talked about how we can go about transferring those assets if it comes up and we need to between the plans. We just haven't figured out the best way to do it yet. So again, you'll see the net position on the balance sheet and the income statement, they both equal out to the 59,227, which as long as you're in balance, the accounting world is happy. The next section is the notes to the financial statements, and these really highlight how we arrived at the numbers, any significant policies that we have. So note 1, again, is the summary of significant accounting policies, and this just states that we follow GASB and GAAP for how we report these things. And then it goes on to describe how the trust was formed and the state statutes that are guiding how we're operating, use of estimates, those types of things. So that one's really just how the OPEB trust, how we report for it financially. Note 2 is plan descriptions and contribution information. So this just details how the plans are set up, who's eligible, the statutes dictating how everything happens. And then it's got a summary of active and retirees, that employees that are utilizing the plans for each one. So it's got the health plan, the PEB plan, and the life insurance plan. So on page 10 is where note 3 starts, and this is just about cash and investments. And so you'll see in fiscal year 19, we had $59.7 million in assets, and of that, $58.9 million was investments, and we had about $870,000 in cash on hand. Everything else is invested in RBIF. So it shows that, and then it shows a breakdown of the investments between the plans, and then how they're measured. So we don't have any unfunded commitments. Our investments were valued at fair value. And then a money-weighted return on investments, which is just a different way to look at these long-term type investments.
Mary Lamont, I have a question.
Yes.
What's the $900,000 sitting in cash to do?
So what we use that for is for when we were paying monthly invoices to the state of Nevada for their PEB plan, we would have to have cash on hand because we would pay it out of the trust. It was used for that, and it was also used to reimburse the district funds for the life insurance implicit subsidy that there is. So there's never a whole lot of cash on hand, but we do have some for those reasons.
Is it still being used for that? Because you kind of said it,
Right.
you made it sound like it was in the past.
So this latest fiscal year, we're not making those payments directly out of the trust. They're being paid out of the health insurance fund initially for the PEB plan, sorry. Those are being made out of the health insurance fund, and then if deemed necessary, we'll transfer them out of the trust to the health insurance fund. So we have even smaller amounts of cash on hand because all we're doing is a monthly transfer for the implicit subsidy, which runs around $40,000 to $50,000, somewhere in there. Mm-hmm. All right, so note 4 is where things get really fun, because this is where the actuarial numbers start to really come into play. So note 4 relates to the net OPEB liabilities of the trust, and that is all determined by an actuary that we contract out with, and it gets done every other year. So this goes through, and the first part just explains their methods and assumptions they use to come up with these numbers. You can see we have inflation numbers, salary increases, investment rates of return, and they're all just things they use to forecast out what this liability could be if everything came to an end right away. There's information on the net OPEB liability broken out by, I skipped over the discount rate. It talks about how the discount rate is calculated and how we use that. So if we have a more favorable discount rate, a higher discount rate, our liability goes down. If our discount rate's lower, then our liability goes up. And in the past couple of years, we've seen our discount rate decline because it's a blended rate based on the expected rate of return and the government bond buyer's 20-year index. So as those numbers go down, that number fluctuates year over year.
Jeff Kirst, on the investment rate of return, the 7.5%, is that normal for this type of trust?
For this one, it is, and that one's determined by the RBIF board, so that's their expected rate of return. And as you saw last time during the quarterly financials, they regularly outperformed that expected rate of return, which is great, but they're the ones that determine that one.
So we're going to get into this, but this discount rate on page 18, I know this is really heavy-duty math now, but this is a formula that the actuary calculates that's consistent with Government Accounting Standards Board regulations. So GASB says how to calculate this discount rate, and as you can see on page 8, I'm sorry, 13. Did I say 18?
You
I'm
did.
sorry, 13. I don't know why you guys were flipping pages. Sorry. It's the top of page 13. So what this says is this is the expected long-term rate of return on OPEB plan investments. If we were fully funded, we could use that 7.5% rate that the PERS board, the RBIF board sets. But because we're not nearly fully funded, GASB says you have to use this blended rate of the 7.5% rate mixed with the 20 bond general obligation bond index rate, which is basically the bond market rate. So it's saying, gee, because the district hasn't fully funded it, you're going to have to pay for a portion of benefits out of your own funds, which are invested in fixed income securities, which is based on that bond buyer index. The point I'm getting to is that you will kind of see our net OPEB liability rising over time, and a large reason why it's rising, and Robert will get into this, but is that our assumed rate of return is going down because, as probably Mr. Kirst knows, right? Bond yields are plunging. The Fed is basically set interest rates at 0. And so the expected rate of return is falling, which means, right, our investment's value is falling. So when you see our net OPEB liability going up, you might say, what the heck is going on? Part of it is certainly health insurance costs rising over time, but also it's a function of this formula and the fact that bond yields, at least for the moment, have fallen. Now, with inflation picking up, we would expect to see bond yields increase. And then we'll see our net liability go down because the expected rate of return, it will be higher at some point. But so it's kind of, like I say, heavy-duty math, but I just wanted to explain that to you. And all agencies are dealing with this that aren't fully funded. Just that expected rate of return is falling because, again, it's largely based on bond yields. Hope that helped. Maybe it didn't, but a lot of this is just formulaic, but it's based, again, on GASB requirements.
Jeff Kirst, one other question. When we go back to page 12, we look at the asset allocation, and the fixed income would be the bonds, and then we've got the foreign equity and the U.S. equity. How do those fit into this calculation, or do they?
So those are also set by the RBIF,
Okay.
and so that's their target allocation, and I'm not exactly sure how the formula works, but it feeds into the long-term expected rate of return.
Thank you.
Based on the breakdown of it.
And these are the real rate of returns, so then you would add in the RBIF's assumed inflation rate to come up with the nominal return rate, which is how they get to 7.5.
All right. So at the bottom of page 13, there's a good table, and this is the sensitivity of what happens to the net OPEB liability with changes in the discount rate. And then on the next page, there's with a change in the healthcare cost. So this one just shows you what will happen if there's a 1% decrease in the discount rate versus a 1% increase in the discount rate. So you can see if the discount rate went down 1%, they'd estimate, our liability would go up by over $30 million. And then if the discount rate increased by 1%, you'd have a decrease of about $24 million in that net liability that we have. So, and then the same thing on the next page with the healthcare costs, and it's broken out by the different plans. So it really does matter with this liability on what your discount rate is. So as Mark said, if we were fully funded, then this liability would be rather minimal comparative to what we have now. But because we're kind of in this mixed boat, then it fluctuates and the liability fluctuates with it. And then the last note we have on there is just a blurb about the COVID pandemic. We had the pandemic, but because we were an Opeb trust, we didn't expect too many things to fluctuate, but we just wanted to point out any major things that could affect the trust going forward. So the next section in these financials is the required supplementary information. And this is just a lot of information put on one page. And as we go forward, actually what I'm going to have you guys do, so the yellow tab on the packet is for the FY20 financials. If we could go to page 15 of that one? 14? Page 20? Yeah, page 14 of the 20 financials. So this will show the last 4 years that we have. Page 14.
Should have a yellow tab on it.
It's page 14 after the yellow tab.
After the yellow tab. Okay. So what we should see here is the Washoe County School District OPEB Trust required supplementary information, and this is the schedule of changes in the net other post-employment benefits liability and related ratios. So this compiles the previous 10 fiscal years, but under the standard we've only reported 4 years, so that's why we're only seeing fiscal year 2017 to fiscal year 20. But this really gives you a good idea on where our total OPEB liability is year over year, and then also the planned fiduciary net position, which is what the actual financials relate to. It's broken down by the 3 different plans, so they all have to be reported separately. So they're on 3 different pages. The first page you have is the retiree health plan, and then the next page is the retiree life, and then the Nevada PEB plan. So just broken down by the different plans, you'll see service cost, and the top section is all actuarial determinations. So these come from our actuarial valuation that we have. You'll see rather large differences between expected and actual experience and changes in assumptions. So those are what they went through the year before and said, well, if we keep going down this road, this is where we should be. But, whether we changed how we were reporting things, we changed how expenses were being accounted for out of the trust. These are changes that were made in the assumptions to get us to the total OPEB liability at the end of the period. So it would match what the actuary has, because that amount is determined by the actuary. The fiduciary net position, those are just summaries of the last 4 years of the financial statements that'll get you to what the actual ending net position are. And then the ratio down at the bottom, that's, planned fiduciary net position as a percentage of the total OPEB liability, that'll show you how far funded we are per this actuarial determined liability is. So for the health plan as of 6/30/20, we're just a little over 19% funded. The life insurance one is 6.5%, and then the PEB plan is almost 44%. So it varies by plan based on how things are out there. So if we were to switch and move assets between the plans, those would obviously adjust with it. So it's a lot of information on just one page, but it's the best way to see it year over year, everything that happens with the trust.
Jeff Kirst, when you had answered my query about moving funds from one section to another. I had noticed that the life insurance one cost was $1 million to supplement that, when there was only $3 million left in that particular fund. So at some point, that might be not necessarily a problem, but be addressed, I suppose, because there's...
Right, and those are things that we're, looking at. Like I said, it's an allocated thing, and it's
Okay.
based on the actuarial valuation. So as we get closer to drawing it down to, zero in terms of net position, we're going to talk about it as we get through the financials for the district this year.
Okay.
It's one of those that we'll work with the actuary and our auditors on how we can actually reallocate those assets.
Thank you.
Yep. And so starting on page 17, there's another set of tables. And this again is supposed to show 10 years, but because we only have 4 years, that's all you can see. But it shows 2017 through fiscal year 2020. And this is what the actuarially determined contribution, which they abbreviate to ADC, versus the actual contribution that the district made. And it shows any deficiency or excesses of what we're funding. So they go through and they determined, hey, if you want to be fully funded, this is how much you have to pay every year. If you don't meet that, then you have a deficiency, and it impacts the discount rate as well, right, with that. So, and then it's just got notes on, again, the actuary assumptions that are used and then the discount rate that is used. And those are broken out between the 3 different plans on 3 different pages.
And so, sorry, this is Mark. Let me interject here a little bit because I want to explain this. So if you add up pages 17, 18, and 19 in the line actuarially determined contribution, it's roughly $13 million. And what this is saying is, if the district wanted to start to fully fund the OPEB trust, it would need to budget contributions of $13 million per year. That's a lot of money, and I wish the district had that much money. Of course, then if it did, the question would be how to spend it. And I'm not sure it would choose to spend it on fully funding OPEB liabilities. But it could if it had that much money, but we don't, as you all know. There is no legal requirement to fully fund your OPEB trust. In fact, most public agencies either don't have an OPEB trust at all or don't come close to fully funding its actuarially determined contribution. There are a few agencies in this area that do, and that's item 2.04. But those are exceedingly rare. I don't know why Northern Nevada we have a couple like that. But in across the nation, most agencies do not fully fund their ADC, and there's nothing legally requiring them to do that. So I'm trying to put it in context for you. But I think it's a useful, metric to say, okay, what are we contributing versus what an actuary would say we should. It's a goal, but boy, is it hard to get there. But we'll go over that more. That's the intention of item 2.04, is to kind of talk about this a little bit more. But so I just wanted to give you that context. We're not doing anything illegal by not fully funding the ADC. And again, most agencies don't fund their ADC.
Question for Chairman. You gave us an education about OPEB trusts at our last meeting. I wondered if you could touch again on how these get formed in general.
Yeah, Nevada revised statutes has explicit authority for a public agency with retiree health costs to set up a trust. And so a number of years ago, more than 10 years ago, the district availed themselves of that NRS section and did form the OPEB trust. And before that law was passed, an agency could fund its retiree health costs in a special revenue fund. But then, the agency can move money around, Once So the benefit of a trust is per its name, once you fund it, right, the district can't go back and just willy-nilly claw back money out of it. So we go back to the first action item we had, which is in that NRS section regarding formation of the OPEB trust, it spells out specifically how you can access the OPEB trust. You've got to, right, put it in this form and make this official request and go through numerous steps. That's the only way the district can access monies out of the trust. It's an irrevocable trust. So in Nevada, agencies can't declare bankruptcy, but in California they can. But even if a California agency declared bankruptcy, a city, and there's been a few, they still can't touch the OPEB trust. The debt holders of that agency's debt, nor any other creditors could ever grab and claw back monies in the trust. So it is a good thing in that it's secure legally from creditors or the district itself from saying, oh gosh, we have a deficit, we need that money, we're just going to yank it. The district can't. So hope that helps.
Thank you.
I have a question also, Mary Lamont. On page 17, where it says the actuarially determined contribution is 8 million, and then what's been contributed is 2 million. So is that a deficit of 6 million? Is that what that means?
So again, what we're saying is, in a perfect ideal world, the actuary is saying you should be
Okay.
contributing 8 million for this
Okay.
particular plan. We only contributed 2.
Okay. All
So,
right.
yeah, it doesn't mean there's a deficit on the books, on the balance sheet or anything. It's really just an actuary's recommendation.
Okay.
Yeah.
All right. So the last schedule in the RSI is a schedule of investment returns. And this just summarizes the annual money-weighted rate of return by the 3 different plans year over year. Again, as we get there, we'll just keep adding years on until we get 10 years, and then the new one will add and the oldest one will fall off. But because we only have 4 years, this is what we get. So the rate of return, or the money-weighted rate of return, was really nice in 2018. In 2019, it started dropping off, and then 2020 was a little bit lower. It's not the actual investment returns, it's a calculated, rate of return that we would get. So as we'll see as we get through the financials coming up, you'll see that the actual investment returns were up. But in 2020 with COVID and things kind of fluctuating, it kind of balanced itself out to that rate of return. So it looks a little lower, but we still did have positive returns for the year. And then the last section of the financial reports is the auditor's report over internal controls. So if they came through and they looked at our processes and procedures and said, nope, you're ripe for fraud here, your internal controls are insufficient, they would note it here. Again, for 2019 and 2020, we didn't have any findings for this, so that's always a good, clean bill of health for both of those. So that's all I got on financial statements, unless you guys have any more questions.
So I'll just point out one other thing. So we've been kind of focused on actuarial calculations, and it's not like they're not important. But again, it's a point in time. It's based on a set of assumptions that, well, we know won't come to pass, right? It's just how far off they are. The one solid, the solid numbers here are in the actual financial statements. And so for the fiscal year 20 financials on page 3, you can see our net position, i.e. the fund balance, i.e. what we have in the bank, went up from 59.9 million to 65 million. That's real. So we've been talking about kind of funny actuarial calculations, but that's a real number. So the trust fund balance basically increased by $5 million. Obviously, that's what we want to have happen, right? Again, we don't want to touch the corpus. We want it to build up. And it did by, nearly 10%. So that's a good thing. And we have even better news when we get to item 2.04.
Okay, so just to clarify, Mary Lamont, when we have the actuarially is pie in the sky,
It's
This-
yes.
and then page 3 or whatever is, this is, we could go to the bank and take out whatever's there.
Yep.
Okay.
Yeah,
Okay.
the actuarial calculations is a projection.
Okay,
They're projecting what future retiree health benefit costs will be
Okay.
for the people who qualify for them. And then it's projecting kind of what earnings will be.
okay,
So both of, just a whole set of assumptions that go into
Okay.
that. Will health insurance go up as much as they projected? Who knows? Will our investment earnings go up as much as they've discounted? Who knows? But again, we talked about the discount rate kind of being this fictitious number that's partly based on the bond market as of June 30th.
okay,
So they're projecting liabilities, and they're projecting the present value of assets, and how it comes to pass, who knows?
right,
But
okay,
yeah, this is real.
okay. So it's somebody just put numbers in a computer and press and go. Okay.
At the end of the day, yes.
Okay.
I mean, an actuary probably would be offended by that, but yeah, at the end of the day, I mean, they have, right, all kinds of actuarial historical information that they're putting in their model. But yes, it's a projection.
All right. No, I'm not quite so over.
So unless there are other questions, looking for a motion to accept the financial statements for both fiscal year 19 and 20.
Mary Lamont, I move that we accept that motion.
Fran McGregor, I second.
Thank you. And again, I should have asked for public comment, but I'll ask it now. Is there any public comment on this item? Okay, so we have a motion and a second. All those in favor say aye.
Aye.
Aye. Opposed, say nay. Okay, hearing none, the motion passes unanimously. Thank you for going through the financials. They're tough, I know, I get it. Hopefully, right, if you, please stay on this trust board long enough that you will start to accumulate, right? You'll, oh yeah, I remember we talked about this last year. And it'll become clearer as we go through this.
And I just want to say thank you for stopping and going over things for me. I appreciate that, both of you.
Okay, agenda item 2.04 is informational only. So for our discussion, again, kind of just more in the way of education and background for you. We gathered two pieces of information that Robert's going to go over. And again, this is just for us to talk about kind of how we got to where we got and what our current practice is and kind of philosophy. And then what are other agencies doing, just so you have a little bit of comparison.
Thank you, Mark. Robert Carson for the record again. So I'm going to direct you to the loose leaf paper that was passed out and not the one in the packet, because we updated some numbers at the end of that piece. So what you have is a 11-year historical summary of how the district has handled contributions and expenditures out of the Opeb trust. The trust was formed in fiscal year 09, if I remember correctly, and they started off with making contributions, and back then the district's philosophy was to do as best they could to match it was called the ARC back then, not the ADC, so it was the actuarial required contribution. And so they changed that terminology, so the district really tried to meet those. So you'll see in 2010 through 2014, there's $11 million plus in contributions in each one of those years. So they were really aggressively funding and overfunding, because there are certain years where the ARC was only $8 million, but they decided to contribute $11 million to it. So that's what really got our fund balance going at the very beginning. You'll see the investment returns, 2010, 2012, a little lower, so we were still coming out of the recession, and then the investment earnings really started to pick up as the fund balance grew as well. The only expenses we did out of there were for the PEB, and those were monthly invoices that are sent over by the state. They're much higher at the beginning of this versus the end because it's a closed system for PEB, and as people start moving away from the plan or passing on, the numbers get lower, so our bills go down. So right now they're running about 3.5 million, somewhere in there, a year versus the $6 million that was there in 2011. So you can see the fund balance steadily growing, and in 2015 we hit a peak of just over $68 million. And in 2016, that's where things started to change. 2015 was really the start. The contributions ended up going lower as the district was struggling with financial times, and the fund balance started to, or the deficits were there, so we couldn't contribute as much. And then in 2016, you'll see there's a $5 million expenditure for retiree medical. So between 2016 and 2018, the district determined that it was appropriate for the Opeb trust to reimburse the health insurance fund for retiree medical expenses that were funded by the district's health insurance fund to the tune of a little over $5 million for each of those 3 years. So a little over $15 million was taken out of the trust to reimburse the health insurance fund. The health insurance fund at the time wasn't in the best of shape, and that's what the trust is there for, is to assist with these payments if it goes, if it becomes a burden on the district's health insurance plan. So the PEB payments, those stayed pretty steady, and then we also decided to start reimbursing other funds for this retiree life insurance implicit subsidy that we have, and it's based on the life insurance rate, and right now it's right around $1 million a year that comes out of the trust that gets reimbursed. So after we did the $5 million disbursements out of the trust, we kind of slowed down and said, whoa, we need to let the fund balance grow back, because if we keep going down this road, we're not going to have a trust. So we kind of limited the expenditure, or the reimbursements out of the trust. We still had the PEB and we still had the life insurance, and then we reimbursed the health insurance one more time for $1.2 million. And then in 2020, the health insurance fund was doing much better. It was determined that we didn't need to reimburse them anymore, and then the health insurance could actually cover these expenditures that were out of there, so we could rely and actually help the OPEB trust grow. So it grew just under $5 million in 2020. And as you can see in 2021's unaudited financial numbers, it's grown over $16 million. We had $17 million in investment earnings this year, or in this past year. So it brought the fund balance up to the highest it's ever been. We're at $80 million as of 6/30/2021, which is great. And it's something that we'll, as Mark alluded to earlier, we'll keep reassessing, based on the needs of the trust and the needs of the district. And it's a balancing act. So do we want to keep growing the fund? Do we want to, help the health insurance fund cover these costs? And it's just a balancing act year over year based on how each one is performing. But as of right now, they're both performing very well. So they're both growing, which is good.
Jeff Kirst, a question.
Yep.
On the years that the $5 million came out to cover the health insurance fund, did that include existing teachers, or was that just the retired teachers who were timed out of this, as I believe is the case?
Right. So it was a calculation that was done to reimburse retiree costs only. So it went through, and there was an analysis done to determine these costs and what could be, reimbursed for versus what was actually there. And the $5 million was determined that it's only for retirees.
Thank you.
So this is a little bit of a roller coaster ride, right? Where the district was over contributing and or certainly contributing at least their actuarially required contribution, right? Which is great if you're able to do it. And then the district in term, it had some significant general fund deficits in 2017 and 2018, and couldn't afford to do that any longer. And we do have a balanced budget. but that balanced budget doesn't provide nearly contributions to this level. We're just not there. Maybe someday we'll return to those days. But at the same token, we've kind of, over the last several years, made this call about, not withdrawing funds out of the Opeb trust, again, to let the trust balance build. As Robbie mentioned, we saw extraordinary returns this last fiscal year, so that's wonderful. Again, we're not nearly fully funded. If we were, just again to talk about the Opeb trust role, if we were fully funded, or say we were 80% or 90% fully funded, and we sat down and said, we've had this great ride in the stock market, but all good things must come to an end, right? What goes up must come down. And it certainly would be within the realm and the authority of the Opeb trust to say, I'm taking the chips off the table. I've seen too many boom years in a row. There's some reversion to the mean I'm going to expect. I want to take my chips off the table, i.e. reduce my exposure to the stock market because I think it's going to come down, and I want to put it in a safer investment. That's certainly within the purview and prerogative of this trust board. Again, it's a heavy-duty investment decision, and we wouldn't take it lightly. But again, I just wanted to kind of talk about what your authority is, and certainly if it came time to where we said, what, I'm not comfortable with this exposure to the stock market, I want to do something a little different, we could talk about it. But as we talked about, I think in one meeting, we've got to then use a consultant, an asset manager, we got to go down that path. But again, our intention here is to try to build up this balance in this trust as much as we can. Again, not touching the principal or corpus if we possibly can. And hopefully we have years where investment earnings are strong and more than cover any withdrawals out of the trust. So that's the current philosophy, but as you all have worked for the district for many years, times change. There may be some good years, there are a lot of bad years. You've kind of got to modulate, your philosophy for what you're dealing with. So maybe this was helpful, maybe it wasn't, but we thought at least you have the history here and could see kind of, again, how we got from there to here.
Jeff Kirst, another question or two. Today we voted to have the school district access $6 million of the corpus should it be needed. How are new hires for the school district included in the trust? As I understand it, they're not. So the people who would benefit, the beneficiaries we know who they are and how it's all going to work out.
You're correct, yes.
It's a closed system at this point. There's no new employees who'd be eligible to receive these benefits. You still have, I do believe, some active employees who, once they retire, will receive retiree health benefits.
Yes.
But it's a closed system in that, the universe of eligible participants is set.
Well, the life insurance portion of it seems to be a blended number between the retirees who probably are there than existing employees who have a life insurance benefit with the district. So that one is somewhat open, isn't it?
You are correct. Thank you for that correction. You are absolutely correct. That is an open system for the life insurance benefits. And when a retiree procures life insurance through the district, it is a blended rate, right? That life insurance rate they pay includes the rate for both actives and retirees. And that's the implicit subsidy sometimes we talk about. If retirees went out on their own to get life insurance, they'd pay a much higher rate than the blended rate. And that's what that implicit subsidy is. But yes, you are right. Every retiree can get life insurance through the district.
But that can be changed too.
Yes, it can.
From what I read in these documents, if things get tough for the school district, then that can be modified and premiums can go up or whatever needs to be done to keep the doors open for the students can be modified.
Absolutely.
Yeah. So there's one last page in that packet, and this is something that was put together just to show a comparison of different agencies in the area, because like Mark said, it's not very common to have people that are fully funded or even close to fully funded. Most people just say, you know, whatever we'll do, we'll pay it as it comes up and worry about it later type thing. But we're in a unique place. So the first column was Washoe County, and kind of tied to that is the Truckee Meadows Fire Protection District. So on here, the funding ratio for both of them is over 50%, and that's, I mean, it's just unreal if you look countrywide and different agencies. Nobody's up there. And they actually do try to meet their ADC every year or exceed it. So you'll see in fiscal year 20 for Washoe County, the ADC was 20.48 million, and they contributed 22 million. And so they're really reaching for that, you know, fully funded model. And I think a little piece of that is their healthcare, their retiree healthcare especially, is a little bit more expensive than what we'd see. We have retirees that have to pay their premiums, whereas Washoe County, it's all on the county to pay for these things if they qualify under certain benefits. And the Fire Protection District is the same way. The third column is ours, and we're about 23% funded with all the plans together. The city of Reno, just over 6%, so they're more pay-as-you-go. It's just a little bit set aside for that. And the city of Sparks is absolutely zero. So they don't pre-fund it. They all do just pay-as-you-go. It's all covered out of whatever plan they have set up, and they don't have anything set aside for it. And Tumwa, this one's actually rather surprising. They're more than fully funded, so they're at 113% funded. So their total liability is $12 million, and they have a planned net position of $13 million. So they went all in on that, and they get fully funded. So if anything were to happen, they're covered. So just some information on how different agencies handle it and their different approaches. Again, just so you guys can see what's going on.
Jeff Kirst, it's very interesting and good. I wondered if you might know the water company used to be part of the Sierra Pacific Power. Did they split that off? Just if you happen to know, I wondered how they did that.
I am not 100% sure, but I can look at it and get back to you. But yeah, no, I'm
no
not
need
sure.
to get back to me.
All
I
right.
just kind of wondered.
You know, it's kind of a mixed bag. I'd point out, you know, again, I worked at the county. Yes, the county's funded ratio is higher than ours. On the other hand, their liability is their total liability is roughly double ours, and they have roughly a third of the employees we have, which goes back to Robert's point. You know, the retiree benefits are really, really nice. But they pay the price in that it's $500 million of liabilities for, like, say, a third of the employees we have. So they need to really fund more. Otherwise, this would crush their health insurance fund. So we just thought this, again, is just, you know, informational for you. Every agency manages this differently. Again, you can see Reno and Sparks contributes nothing, and there's no, again, that's not illegal, right? They choose to do that. They're more like the typical agency, public agency. Reno started a few years back funding it, but again, they're only funding 6% of their total liability. So we're somewhere in the middle. You know, so hopefully that was helpful. So that was just for information and discussion. Appreciate the questions and conversation. And again, hopefully over time, this kind of accumulates and makes sense every time we meet. And most meetings are not this long. So thank you for your patience. In terms of next items, our next meeting is Monday, November 22nd at 3:30. If you can't make it due to Thanksgiving plans or what have you, if you could let Val know, We want to make sure, we do have a quorum before you come in. So if something happens and that's not possible for you, if you could just let us know, then we, may want to reschedule. And then the next item is public comment. I don't see anybody in the audience. Val, have you received any public comment online?
Any additional comment?
Okay.
Jeff Kirst with one question.
Yes,
We
sir.
did have the email public comment. Are we supposed to address that, or it was addressed, I think, very satisfactorily by the team's talk about the numbers?
Yeah, it's the district's practice not to respond directly to public comment, but you've received it, and you can consider that public comment, and, if you thought it was a good question, you could ask it, but we don't typically respond to public comment like that. Okay, with that, the meeting is adjourned. Thank you very much.
Thank you.